All right, welcome to this quarter's 20 Minutes on the Market, our quarterly update on all things market and economy. We pick out some of the topics from the most frequently asked questions. If you've watched the last handful of these, you're going to notice that we are continuing to develop some of the same themes. And that's because those themes still are the predominant things out there driving the economic activity and subsequently how the market kind of is reacting. So we're going to continue to develop looking at what's happening with inflation. You've probably seen headlines reporting different things there. That will lead to when interest rates will finally start to come down. And then one we wanted to throw in here, because we're in an election year, is a little bit of a historic look at how the markets respond in election years. So we're going to jump right in. Grant, do you mind getting us kicked off by looking at the economic activity as represented by the speedometers that probably folks are used to looking at by now?
Yeah, let's take a look at that. So again, these speedometers are forward-looking about 6 to 9 months, economic indicators of where things are headed, prepared by the analysts at the City National Rockdale team. So I want to highlight just a couple of these that we saw some improvement. There is more green on this screen than there has been in quite some time. Number one at the top there, you'll see consumer sentiment has grown over the last quarter. So people are feeling more positive about the direction of the economy. Not saying we're out of the woods, but more positive. Labor market is still tight, but showing opportunity. We saw some shifts, positive shifts in housing, more new homes being built, and a spike upward in existing home sales, which was positive for that. Consumer spending has remained to be strong over the last quarter and holding steady. We've seen a big uptick in the forward look on corporate profit growth. This is a really positive thing for the economy when you're looking forward, because that's what drives the value of all the companies that you own and that you do business with. And inflation, we've seen some positive steps in that. That is a very sticky area we're going to unpack further, but we have seen some positive movement there. And a little bit of more opening up of credit availability to businesses and consumers. On the red side, we have a negative on equity market valuation. We've seen a lot of spikes in tech, which is pushing parts of the market into kind of more of an overvalued range. And then we have those geopolitical risks, conflict in Israel continuing, and Russia, Ukraine. And so you're going to see a continued battle here for getting inflation down in the US, waiting to see when the Fed will start reducing rates. We don't expect them to increase it, but it's a matter of more when they're going to be reducing them, which will be a positive indicator for growth in the market. So if we look forward a little bit, I want to highlight two key areas here. One at the top is GDP growth, so gross domestic product, output of all of the goods and services in the US. For 2023, we saw about 2.5%, and it's expected to be in that 1.5 to 2.25 range in 2024. This is a different tune than we had 6 to 12 months ago. We're expecting it to be more like 0 to maybe even negative. So this is a positive marker. The next one I want to point out is the headline CPI, so Consumer Price Index. 3.3 for 2023. This is the rate of inflation, the rate you are seeing general goods and services getting more expensive. And in 2024, it's expected to slow that rate a little bit more to 2.5 to 3.25, which is a positive sign, even though this has been kind of a sticky point for our economy. Going forward, our trajectory is really going to depend on how fast our rate's going to be cut and when.
And yeah, that's a good point. Diving a little deeper into the inflation question. First of all, so we're going to dive a little bit deeper into that in this chart. There's a ton here that I'm going to break down a few key components of. One thing that's important to remember when we talk about inflation coming down, it's really common to think inflation coming down means prices coming down. And that's not what it means. Prices consistently tend to get more expensive. Rarely do prices actually trend downward. But remember, inflation tracks how fast they're getting more expensive. So if inflation is 2, that means things are getting more expensive at 2% per year. If inflation's 4, it's getting more expensive at 4% per year. If inflation dropped from 4 to 2, that year it still got more expensive. It just didn't get more expensive as quickly. So what the Federal Reserve is primarily concerned about is when inflation persists over about that 2% rate, that's when we're going to see them take corrective actions, historically speaking, generally by raising interest rates to kind of control some of the energy in the economy, if you want to think about it like that. So what's actually happening with inflation? Well, on the left here, there's a couple things that we see. The dark line at the top tracks the inflation rate over the last handful of years. But then underneath it, you have all these different colors. So in the darkest gray here, you have services that exclude shelter and energy. You have goods, food, energy, and shelter. So that includes costs of mortgages, things like that, but also rents. So let's look back here in June when inflation peaked out, June of 2022, when inflation peaked out at just over 9%. What we notice is underneath there, you have quite a bit of each band, which means everything was affected by that spike in inflation. So then we all remember the Federal Reserve boosts interest rates at a historic clip, and inflation starts steadily coming down over that next little bit of time. So now that brings us to kind of the start of 2024. One of the things we notice, okay, well, so here inflation is down, you can see it kind of lining up with that high 3% area. But what do we notice underneath that? The vast majority of the colors have disappeared or shrunk considerably, except the light gray bar here, which is shelter. That tends to be one of the stickier prices when it comes to inflation, but it's one of the most important indicators that the Fed's looking at because it affects everybody. Everybody needs a place to live. So whether you're renting that place or whether you're buying that place and paying the correlated costs, even though inflation is coming down, which we might expect to be an indicator that they should have, why aren't they cutting rates by now? It's that shelter inflation rate is a key one that they look at to decide, is the economy actually sustaining a lower inflation rate in a way that everybody's going to feel, and then they're going to behave accordingly. So on the right here, you kind of see if we just isolate the shelter component, you're actually still seeing some spikes kind of up and down and all over the place. And so really until they see that at a sustained lower level, we don't expect them to start cutting rates. And they've kind of indicated we might hold them steady for longer. They're probably always going to be a little bit conservative in what they say. If they say we're definitely keeping them flat for the rest of the year, they might still in the back of their mind be going, we have the chance of cutting it. But what that does is it gives them the ability to have a surprise be a good surprise, not a bad surprise. So regardless of when they cut rates, which is something everybody's kind of paying attention to, a question we're getting is, well, what happens to the market when rates do get cut eventually? We know what happened when they got raised in 2022. That was not great at all. What happens when they get cut? Well, the annoying answer that advisors like us give is, Grant,
It depends.
it depends.
It depends.
Okay, so the reason why they're increasing rates, sorry, cutting rates, dramatically affects the impact of the market. So there's three categories here that the analysts have historically assessed here. One is normalization. Think when the Federal Reserve has increased rates for a period and they're cutting them to bring them back down to average rates. That's what we would be experiencing here in the near future. They increased rates to control for really high inflation, and they'd be cutting them to bring them back down to a more normal rate versus emergency times like COVID. When COVID hits, the economy shuts down, they dropped rates pretty dramatically. And the goal was to bolster the economy there. And then in a recession, it's also common that they will cut rates at that time as well to try to create a little bit more flow through the economy. So let's just zoom in on when the Fed's cutting rates to normalize. What happens over 3 months, 6 months, and 12 months? Well, when the Fed's cutting rates to normalize interest rates over that 3-month period of time, on average, goes up about 4%. Over that 6-month following period of time, about 9.5%, and about 13 over that following 12-month period of time. So you can see if you like diving into each of these here, you can do so. You're welcome also to contact us, and we can help provide some of the background information if you're the history or finance nerd and like to know what were each of these major events and so on. But what this tells us is there's some promise that when the Federal Reserve goes to cut rates, because we're in a period where they would be doing that to normalize those rates, that historically speaking, at least, that has been positive for the stock market.
Yeah, so let's zoom out for a second and take a look at what has the market been doing. So a lot of numbers on this page. We want to focus on just a couple of them here. So just start with the S&P 500, 500 largest U.S. companies in the U.S. In 2023, it was up around 24%. A lot of recovery from the big drop in 2022. And we've gotten a lot of rally from the tech stocks kind of carrying the torch here a little bit in our rebound. That's Apple, Amazon, growth companies like that. Versus when you look at, say, S&P value, you'll see 7.4 year to date. Those include more of the stable blue chips, Bank of America or Johnson and Johnson. So companies that typically are more mature and or pay profits out via dividends. International stocks measured by the MSCI EFA, as we call it, they're towards the bottom, 5.46 and 15 over the last year. For international markets are trailing the US, and we actually expect that to continue. And here at the bottom, you'll see bonds, and a big number jumps out is a 3-year of negative 2.5. This is largely because of the inflation and the volatility in the interest rates has caused a lot of pricing changes in the bond market. Not totally be dismayed for the more moderate income generating investors out there that have a lot of bond vehicles. You're now getting over 2+% more off of all your bonds. So your cash flow has gone up in your portfolio, which isn't represented here. So you're getting a lot more interest off of those. And then on the dividend stock, so if we narrowed it down more, if we look at really high dividend companies over the last 3 years, they're actually down 1% or so. So a lot of disparity across the market, which we're going to unpack a little bit more because things look good here overall on average. But when we start breaking it down, you'll see there's a little bit more to the story to understand here.
Yeah, it's particularly important for anybody who's watching this who is in the income phase of their portfolio. Because what are two key components to an income portfolio? Dividend paying stocks and interest paying bonds. We just talked about those being two of the worst performing categories over the last 3-year period of time. And so folks might be simultaneously looking at their portfolio that's geared to pay them income and then watching that compared with something like the S&P 500, which is just intended to be very, very growth focused, very heavily weighted toward tech stocks, which we're going to look at on this chart. So it's important, again, we'll cover this a bit at the end. It's important to make sure I'm tracking the right benchmark for my portfolio. Diving a little bit deeper into the S&P 500, one of the things that if you've watched this recently, you've heard us say something like this, but the S&P 500, yes, it tracks 500 companies, but the biggest companies carry the most weight. So on the right here, we see that. Of 500 companies, if we added up the biggest 7, which are all big tech companies noted over here, those 7 companies make up about 29% of the weight of the S&P 500. The other 493 companies make up about 71%. So that's clearly the story is not all companies act equally and are represented equally when we look at what the S&P 500 is doing. So if we look at, for example, what happened in the dark blue in 2023 and in the light blue, what's happened year to date. The S&P 500 overall is up about 26% in 2023, assuming dividends were reinvested, and then 10, a little over 10% so far this year. If we took out those 7 biggest companies, you're only up 10 and 6. If we equally weighted each of them, regardless of the size of the company, you each get the same size seat at the table, 14 and 8. So if you have a portfolio that's pretty evenly diversified, you'll be lagging the S&P 500 when it's going up, and you'll probably lose less than the S&P 500 when it's going down. So important to have the right benchmarks that you're tracking. One other question that we've gotten kind of frequently, or just observation, is when I look over the last 2 years, and folks kind of looking at as of the end of 2023, between 2022 and 2023, I don't know that my portfolio did a ton. Well, your hunch is borne out in the data here. What this chart shows here is $1 million invested in a handful of different indexes over that 2-year period of time. So let's just look along the bottom here and pick out a couple of examples. Between 2022 and 23, the S&P 500 on average was only up a little over 3% over those 2 years. Tech stock, the NASDAQ was down about 2%. Dividend stocks were up a little bit over that 2-year period of time. And then bonds were down pretty dramatically. So if you feel like I've kind of seen things kind of drop and then come back and I'm kind of even point to point, it's been that kind of 2 years in the market. So though we've seen rally in some areas, it hasn't been equal across everything. And it does bring up some interesting things to observe about valuations.
Yeah, and the valuations show a very different story or kind of continue along this thread. So I want to highlight a couple things here. So one on the bottom chart here, you'll see this S&P 500 forward price earnings ratio. So this is one metric to use to measure the value of a company and or a broad base of companies in an index. So what is price earnings index? It's simply price divided by the earnings. So if you had a company that was worth $10 a share and it produced $1 of earnings, it would have a price earnings multiple of 10. And so that's one valuation metric. So when we look at there in the bottom, you'll see we're in the red, we're in the overvalued range. And so people might be saying, well, we got a bubble building? Is there something going on here? Not necessarily. If we look up to the right, you'll see again, like Josh was saying, not all companies are created equal. With those 7 tech titans in there, the forward price earnings ratio is 31.8%, which is part of that overvaluation that I just talked about. If we take those 7 out, now we're in a more normal area, more close to normal area of about 18.7. So not all companies are created equal in the index. But let's contrast this to another side of the equity markets and look at dividend stocks. Completely different story. Our same chart there over on the left, measuring the price earnings multiples of these companies, we're in an attractive valuation zone because remember, they haven't had as big a growth. Those companies don't have big growth when you're in these more slow, sluggish GDP environments. And so we're actually seeing attractive valuation there. And on the other side, you'll see the growth rate of their dividends. Their dividends have increased consistently here over the past 10 years. You'll see the curve there, a 7% average growth rate of dividends. So investors that are relying on solid companies that will create solid income for them in the retirement income generating years, they have opportunity in front of them. They have good valued stocks here, and they've grown their dividend rates substantially over the last 10 years. And when interest rates do start to creep down, the economy moves to more of a positive growth curve. These companies typically are going to experience that growth that those investors have been waiting for.
Yeah, and so this is particularly helpful if you are an investor who's taking lots of income from your portfolio. Why would you hear us say something like, even though this category has not performed well, it could be a good idea to consider sticking with it? Because the stable and increasing income, and then there are environments where those tend to increase. So helpful context there. Thanks, Grant. Uh, okay, so let's turn to wrap with the kind of bonus question that we talked about. So what does the market do in election years? A lot of people, it's very, very common to think we're in election year, the market's going to go crazy. Should I move to safety? Or should I invest more? What trends can we draw out of this? So we found this analysis interesting. Since 1928, here's what the S&P 500 has done in election years. So we'll just focus on the blue, which is the average. In election year, in then year 1 of the presidential term, 2 when the midterm elections come, and then 3. So on average, in election years, it doesn't seem like the market cares that much. On average, it's up. It's not super exciting. The biggest gains seem to be on average in those last years or the third years of a presidential term. So there isn't any clear historical evidence that we should be concerned just because we're in an election year and make any different investment decisions. Along the bottom, it tracks the average return of the S&P 500 annually when there's been all Democrats in office, a Democrat in the White House, and then Republicans in Congress. Every iteration here, the only one that's down is the one here, and that's because that included the 9/11 attacks in 2001. So we wouldn't point to that to say that should guide us on what to do if there's Republican in the White House, Democrat, or split Congress, essentially. There was such a massive outlying factor there. So from our historical assessment here, what we'd say is it doesn't matter that much. The market cares more about what's happening in the economy. So that brings us to a few themes to remember. Some of this will look familiar. Not a lot of this has changed because a lot of the developing themes haven't changed that much. your portfolio should reflect your goals. That's why a high income portfolio might make sense for you if you're retired, and a higher growth portfolio makes sense for you if you're still accumulating. Your portfolio story helps us track the right indexes. You should make sure your safety, income, and growth buckets are stocked appropriately. And most importantly, you should reach out if there's any questions, any concerns. So with that, we'll thank you for your attention here. For more resources like this, you can check out our Insights blog, and we'll see you next quarter.